Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and we apologize for the the little bit of the delay that we had here. So just waiting for everyone to log in. On today's Barometer Readings webcast, we will be pleased to provide you with a brief macro overview. And of course, at the tail end of the conversation, David Burrows, our Chief Investment Strategist, will be pleased to address your questions. Don't be shy. You can hit up David or myself with your questions on the Q&A or the chat via Zoom. And with that, on this beautiful December 5th afternoon, I turn the conversation over to the one and only David Burrows. Good afternoon, David. Nice to see you.
Nice to see you, Pam. Maybe it's nice where you are. It's not so nice where I am. It's chilly here in Toronto today. Thanks everybody for joining us. Lots to talk about. It's been kind of nice to get a chance to catch our breath this week. It was quite a month of November. Lots to stay on top of. Market's been taking a breather over the last 3-4 days. A little bit of rotation, but a few things to talk about. Why don't we start from the top? As usual, we continue to believe that we're in a structural bull market that started in 2013. We're probably halfway through that. They tend to last anywhere from sort of 15 to 18 years. We got going in 2013 when we exceeded the highs from the year 2000 and exited the structural bear market that included both the tech wreck and the financial crisis. These are both periods of time we'd like to avoid. They don't tend to happen very often. Those types of declines happen about every 40 years. So we probably have some time to go before we have a similar period like that. But the net of it is, we have been working our way through this correction that started in December of 2022. We're yet to make a new high. We're about 4% off new all-time highs in 24 months, which feels like a long time, I'm sure, to you. It feels like a long time to me. But we're in the kind of market where there are things to do. Things are getting better, and we have to move forward, one foot in front of the other. S&P made its low in October of 22. We were quite convinced that was probably the important low. We were about 25% off the highs in the S&P. More than that, of course, in the NASDAQ, about 33%. And in the small cap tech stocks, like 70 or 80%. Since then, we've made a series of higher lows, and it's not without being tested. In March of 2023, this low was important. We'd broken the downtrend. We came back and retested it, which often happens when you have a downtrend. You break out and you come back and retest. At that point, we went from really just the 7 or 8 big tech stocks leading the market to a broadening market, meaning more companies participating. We had a seasonal 10% sell-off that went on into the end of October. Once again, our equity breadth models turned positive right in around the end of October, beginning of November. We had some very important gap breakaway liftoff days where advancers, were way ahead of decliners by kind of 10 to 1. We talked about at the time when the S&P had declined more than 10%, held its low for 10 days, and gained in price 9 of the 10 days, going back to 1954. These were very important lows. What came out the next 12 months was quite strong. We know that November was a very strong month. We know during the month of November, we had greater than 60% of the components of the S&P 500 make a 20-day high. This was the first signal in over 6 months. And when that took place, courtesy of my friend Ryan Dietrich at Carson, when you looked out 6 months later, market was up 73% of the time, 12 months later, up 100% of the time, 15 out of 15 occasions, and for an average return of 18%. So these kinds of statistics continue to pile up, and they pile up against, I think, still quite a negative attitude about the economy looking forward. We are less positive about the Canadian economy than we are about the US economy, but in general, markets have been quite healthy and are pointing to stronger stronger conditions. Now, this year has been a tough year for a lot of managers. You know, the top 7 stocks are up 20 times as much as the rest of the S&P. So hard when, you know, you don't necessarily want to be completely concentrated in a small number of stocks, particularly when they're pretty expensive. But we have seen improving conditions. You know, the reason that we're cautious on having a very significant weight is the top five stocks in the S&P make up about 26%. You have to go all the way back to 1964 to have had a greater concentration. It doesn't tend to go on a long time. We highlighted last week that while there are lots of years where the cap weighted S&P 500 or the market cap weighted S&P has outperformed the equally weighted, you know, as we have this year, we about equivalent to the outperformance that happened in 1998, which previously was the biggest year of outperformance for cap weighted. There have been lots and lots of years, and in fact, more years where the equally weighted S&P outperformed. And very often after big years of outperformance for the cap weighted S&P, the equally weighted index takes over. Now, we spend a lot of time talking about breadth at Barometer. We find that healthy markets are characterized by more and more stocks participating in a rally, which would then favor an equally weighted index. When we look at comparing or doing a comparative chart, equal weight S&P relative to the market cap weighted S&P, we think this is really interesting. After a year where the equally weighted S&P underperformed, in the last 3 weeks, we've seen a big uptick in the average stock. That's a really healthy thing. When we came off the lows in 2020, for the next 2 years, equal weight outperformed. And so this is important because most portfolios don't have a very, very high concentration in a small number of stocks. They're more diversified than that. And we like to see more opportunities across the index than just the very top stocks. So I think that that's a healthy condition. That's an improving condition and one that we want to make note of. Now, we've highlighted that this is all happening at a time when people have been throwing in the towel on stocks. And I understand it. It's been a frustrating couple of years. But that being said, when you get to the other side of that, you get lots of opportunity. So outside of the US, Japan continues to perform really, really well. We've seen great performance there all year long. We're seeing very strong performance in India, making actually new highs today after many years of underperformance. We noted that we've seen some improvement in Latin America. And I also want to highlight that we're seeing nice relative improvement in the Euro Stoxx 50 relative to the S&P. So that's also important because, as we've highlighted, for the last number of years, the US stock market relative to global equities had massive outperformance. And we noted earlier this year that we had started to see better performance coming from outside the US in certain markets. We just talked about Japan and India. We talked about Latin America and Europe. So that's an important theme. And when that starts, it tends to go on for a long time. So important to keep our eyes open to changes in the structural conditions. It's easy to look backwards. Our job is to look forward and say, where is the risk reward? And so one of the things that we've been doing is focusing more and more on global equities, particularly in our global fund. And we're going to focus on a new global equity product coming over the next month. The one area that is not performing well is China. And I think lots of people have looked for a turn in China. They've certainly tried to stimulate. But this is the ASHR ETF, which is aimed at mirroring the CSI 300 China A index. And you can see basically making new lows today. So this is the one global market that we are short in our global portfolio. When we move on to bonds, we saw generational low in interest rates. These are 10-year treasury yields going back to 1790. It's an important low in yields in 2020. Last important low was in the late 1940s. And when rates turned, the types of things that did well were quite different than the things that did well during falling rates. So after a long decline in 10-year Treasury yields, certainly we've had a number of pullbacks along the way. Bond yields rallied to just above 5%. Here we are today at 4.18. We've had sort of a natural pullback to the point where they broke out. We'll see where they go from here. But certainly when the yields pulled back, bonds rallied, but other assets rallied more. So we keep that in mind. Importantly, despite the fact that bonds rallied, bond proxies or high dividend paying stocks that have very little growth really have not garnered any outperformance. In fact, dividend growth stocks are outperforming since the lows in October. If we put a point on it, we go from November the 1st to December the 4th, and take a look at what's happened. The equally weighted S&P is up 6.36%. The dividend growth ETF RDVY up 5.74, virtually the same as the equally weighted S&P. High dividend paying ETF up 4.2, and the aggregate bond index up 2.71. So while our view has been that we would see a rally in bonds coming off those lows, we preferred to focus on dividend growth stocks as opposed to bonds themselves, benefiting a little bit more both in capital appreciation and certainly better from a tax perspective. Okay, so moving on. Commodities. Commodities made their low in 2020. Nice rally into the Fed tightening cycle, broke out, very sharp breakout, been pulling back over the last short while, still in a very nice uptrend above all the rising moving averages. Copper broke out over the last 2 weeks out of the consolidation that had been during the Fed tightening cycle. Again, as we said earlier today, when you break out above a downtrend line, you often come back and retest it from the top, which we've done over the last few days. And gold broke out to a new all-time high on Sunday evening and has now pulled back into that breakout point. All of those things are very constructive. When we look at commodities relative to the equally weighted S&P, after many years of underperforming, had they been outperforming now since the middle of 2021, and look to continue. So look, we don't have to be everywhere. We have to target. Our job is to use the tools that we have to try to identify market leadership themes, things that have a structural tailwind, things that can be revalued versus other assets over a period of time. When we say leadership, that could be industry groups, it could be geographic regions, it could be specific asset classes, or it could be specific characteristics like growth or value. Our job is to try and identify what's well suited to the current market environment, where is money getting put to work, what is seeing fundamental improvement, and focus in those areas. Now we have to keep retesting those thoughts, and that's why I do this webcast every week. It forces us to rethink and work through all of the various themes that we're looking at to see if anything's changing, new leadership emerging or old leadership receding, and be prepared to make change in portfolios as is required. And in the absence of any kind of leadership, sometimes we get to those corrections where absolutely everything's being impacted. It's important to have the ability to be in cash at certain points in time. So our portfolios are tactical. They do change. Ideally, when you get into some structural themes, they last for a long time and you get to take advantage of them. Certainly, there's some pretty clear ones right now. But it does mean that we're going to look quite different than an index and unlikely to mirror an index return. We use our key tools. We use some top-down tools to identify parts of our investable universe that we want to focus in. And really what we're looking for is areas of improving breadth, where higher and higher percent of securities are performing well. We run our bottom-up work to try and find very specific securities that are benefiting from improvement in their financial conditions and are technically sound, and where we can find parts of the market that are seeing improving breadth and they line up with specific securities that meet our business tests, well, that's where our portfolio should live. This addresses each of the three key factors that drive return in a portfolio. The last piece is probably the most important piece, and that is a very disciplined selling strategy. A portfolio is a living, breathing thing. Market conditions change. Fundamental conditions for companies change. We have to be able to continually reassess what we own and be prepared to say, we're wrong, the market's right. And so by using stop losses on all of our positions, it makes sure that little mistakes don't turn into big ones. Because at the end of the day, we only need 20 to 30 positions out of a universe of 60,000 we could choose from to build a portfolio. We want to make sure that 20 to 30 positions we have are the best positions that we could have. And if something emerges as a new theme that maybe has a better tailwind, we have to be prepared to trade up. From a top-down perspective, we're looking for areas of improving breadth. When you go through a decline, you get to a point where almost nothing's working. Generally, the strongest securities turn higher first. We're looking for groups of securities where over time, a higher and higher percent of securities are participating in a rally. That's a healthy market. We're happy to be invested. When we see deterioration in breadth, the weaklings under the surface starting to break down, even if the leaders continue on, it tells us that our risk reward is changing. We should tighten up our stop losses, reduce our tolerance for risk, stop putting any new money to work in this group until we see ultimately a correction run its course and see breadth start to improve. So it's all about trying to be tactical here and picking our spots. Okay, so at the end of October, the various measures of breadth that we use were all negative and had been really since the beginning of August. Over that period of time, we did build up a cash weight. We did get stopped out of some positions, but we weren't putting money to work because breadth was deteriorating. In the first week of November, things started to shift. And by November the 28th last week, all of our long-term indicators were positive for the US. For global equities, Canada had not turned up, notably. Percent of stocks trading above the 50-day moving average for all three of those universes had improved. Percent of stocks with positive weekly momentum had improved. Percent of stocks making new highs versus those making new lows had improved. And the percent of stocks trading above the 150-week moving average, 150-day moving average, had got north of 50. That was from exceedingly low levels in the end of October. As we progressed from last week, a couple of notable changes. You can see our breadth model for Canada finally turned higher. I don't like the fact that it was lagging, but the fact is now conditions are improving. If we look at the percent of stocks of the 50-day, it continued to move higher. Percent of stocks with positive weekly price momentum now pushing on 90%. And the percent of stocks trading above the 30-week or 150-day moving average moving higher. So all of these measures continued to improve. Now, despite the fact that the indices didn't move a lot. On the 30th of October, you can see that very few sectors were in capital letters on our distribution curve. And just as a reminder, the sectors that are at the far left have the smallest percentage of stocks in uptrends, and the furthest on the right have the highest percent in uptrends. Now, when we fast forward from the end of October to December the 4th, we can see that today, the average sector has 42% of companies in uptrends. So we're moving to the right. The groups that are the strongest from a breadth perspective, meaning the highest participation, the strongest internal strength. Builders, insurance companies, semiconductors, steel, Wall Street, which is asset managers and capital markets banks, business products, aerospace, machinery. These are all pretty economically sensitive groups, and that has been the case all year long. So for those looking for recession, these at this point are not showing that market participants believe there is recession coming. At the lower end of the spectrum, they tend to be sectors that are more defensive by nature. Telecom, biotech, drugs, consumer staples. Now, if we were headed to recession, it is likely that these groups would be leading, yet they have the smallest number of stocks in uptrends. The other thing I want to point out is this. While oil has been a great place to be all year long, breadth in the oil sector has been weak since the end of October. So not only have we not been adding any new energy positions, we have paired some energy weight. So let's take a look through the groups. Certainly, technology continues to be a strong sector. When we look at the XLK ETF, made up of really the biggest of the big tech stocks, relative strength has been improving since the beginning of the year. It flagged just a little bit over the last 3 weeks relative to other groups, but certainly very close to new 52-week highs. The strongest area within technology has been cybersecurity for some obvious reasons. There have been some high-profile hacks. Certainly, companies are very happy, not happy, very willing to continue to spend money to make sure that their data is safe. The sector is seeing rising relative strength over the course of the month of November, which was a very important month for the market. And importantly, we do have some exposure in this group in Palo Alto. When we look at software, software has continued also to see a nice rising relative strength theme. Microsoft, Salesforce, Adobe, Oracle, this whole group performing well. ServiceNow is a holding that we have here as well. One of the things we highlighted last week is semiconductors relative to software, even though they've been performing well, have been weakening relative to software. And we have reduced our exposure a little bit here. When we look at the SOX index, which is made up of a market cap weighted set of holdings, you can see that the relative strength has flagged a little over the last couple of weeks, something to watch. But at this point continues to be trading better than 85% of companies in the S&P over the last 52 weeks. So technologies continue to act well, but it's certainly not the only group in town. Insurance has been outperforming all year long, and particularly property and casualty insurance. We've seen a nicely rising relative strength line. We've seen steady breadth across this group almost for the entire year. It's been one of the 2 or 3 groups with the best breadth, and for good reason. Rising rates mean that their bond portfolios generating better returns, and ultimately their investment returns have been improving as well. Within the banks, we really haven't had a whole lot. JP Morgan really has been the one position we've had all year long. We've talked about the fact that we've stayed away from the Canadian banks. We've not had any regional banks for months and months. But JP Morgan continues to rally. We're really basically at new 52-week highs for JP Morgan. I just want to note 2023, the estimate is for $16.66. That's roughly double what they earned in 2020, and just about 3 times what they earned back in 2014-15, despite the fact that the share price, really is not fully reflected that. Canada. We certainly have seen some improvement in Canadian banks, but we look at this as opportunity. Is it opportunity lost, or are there other things to do? And at this point, the relative strength of the Canadian banks versus the market is not showing gains. So while it's getting a little bit better, relative strength is not improving at this point. We think that there's other things to do. Moving on. Energy. Now, energy is a polarizing group, and polarizing for lots of reasons. Polarizing because there are people that believe we shouldn't have any carbon-based energy. Polarizing because the sector fell 90% from 2015 through 2020. Polarizing because it had such a great rally through 2020, 21, and 22. And polarizing because it has pulled back a little bit over the last month and a half. Relative strength has pulled back, but it continues to be in an uptrend that started back in 2020. So our view is likely longer term, this continues to be a strong group. We broke out of the range it was in during the Fed's tightening cycle to the upside, and we have been holding over the last month. Now, much more weakness than that would cause us probably to reduce our holdings further. But when we look at some of the components, they've continued to act really well, particularly CNQ, Canadian Natural Resources. When I look at this, we're trading it with an 83 relative strength that's been rising since March of 2020. We're getting paid a 5% dividend to hold this one. Dividends are growing at just over 20%. We have to balance off near-term consolidation from breaking down. And at this point,
it looks like the group is consolidating. So let's move on from energy. Industrials are basically back at 2022 highs. See, they made a high at the end of November. Retested that high in July, then the market had its 10% pullback, and very quickly we've regained basically back to the highs. Now, this is an equally weighted basket of industrials. It's the VIS ETF. We've talked about some of the names that we have in the group, but in particular, we're here because there is a reshoring taking place in the US of manufacturing. There is a realignment of supply chains, and there's a lot of companies benefiting. Now, we've talked about defense as being an important group for us for obvious reasons. There's lots of visibility in their earnings and a long lead order book. But we are seeing strength in other areas. We've talked about some other names over the last little bit. Eaton Corp is a diversified industrials company that we own. It's got a dividend of about 1.5%. It's trading better than just about 90% of companies in the S&P over the course of the last 12 months. And we think that this gives us a great global exposure. It's about 60% US, 40% the rest of the world. So continuing to perform well. Moving on, in the materials, uranium continues to chug along. Cameco made new highs again this week. Next Gen Energy made new highs over the course of the week. And the steel ETF made a new high over the course of the week. So, this, I think, has to do with this industrial renaissance going on in the US. It may well be that the consumer gets pinched, but the industrial companies are supplying goods to the world. Supply chains being realigned probably benefits US steel manufacturers. When we look at the metal and mining companies in the materials, also continuing to behave well, just broke out over the last 3 weeks out of the consolidation that's been going back over the last Fed tightening cycle. So this group, while it is a highly economically sensitive group at a time when people are concerned about the economy, is not giving us the message that it's under pressure. And I think that's important because it's an under-owned group. It's not well loved. And there are just some great companies within the group. Gold this week broke out to a new all-time high. So on Sunday night, had a thrust higher and has pulled back over the last couple of days. But again, broken out of this cup and handle, and again, looks very interesting. I think a lot of this has to do with the fact that we're seeing such a strong pickup in construction spending. This is from the Fed's database. Total construction spending on manufacturing in the US, you can see the ramp up through 2022 and 2023. That offsets a lot of weakness in the consumer. Home building in the consumer making new all-time highs. I think that's interesting. Some rifle shot positions that we have in the consumer acting really well. Uber's had a great run since the end of October. Costco making new highs, and Dollarama. The thing you take away from this is sort of lower end retail, not looking for particularly high consumer spending, and platforms that have particularly good online businesses. Bellring Brands in consumer staples is selling protein shakes and power bars through Costco and Walmart, and Lululemon with their online platform just continues to do particularly well. So we do have some consumer exposure. It's just not a lot of consumer exposure. The positions that we have, I think, are acting really, really well. And then, of course, there's the 64,000-pound gorilla, Amazon, coming into Christmas, trading basically at 52-week highs. So there's other things to do. Consumer staples can't really get off the carpet. So Bellring Brands is consumer staples, but it's not one of the big consumer staple companies like Procter & Gamble or PepsiCo or Walmart. Relative strength not getting off the carpet. Healthcare, things to do. We're there in Lilly and we're there in Vertex, but as a group, relative strength remains weak. Utilities, they've done a little better over the last couple of weeks, but so is the market. They've not made any gains from a relative strength perspective. And the telecom stocks, same thing. AT&T's had a little bounce, and the group has had a little bounce, but on a relative basis, continues to underperform the S&P. So we're in a market where we can differentiate, and all groups don't act the same. We have a significant weight in technology. Financials, we have an overweight. Energy, we have an overweight, but you can see the positions come down a little. When we look at materials, we're overweight. Industrials, we have a significant weight. Healthcare, staples, consumer discretionary, communications, real estate, and utilities are underweight positions for us. So we're working our way into a better environment. I think that we're positioning groups that continue to behave pretty well. Outside of our traditional portfolios and our macro portfolio, we do have exposure to Bitcoin. And Bitcoin looks as though it is starting a new leg higher. When we do a comparison of Bitcoin versus the equally weighted S&P, if I go back over time, it broke out versus equal weight stocks in 2016 and had a very significant run. It broke out versus the equal weight S&P midway through 2020 and a very significant run. And has only just recently broken out versus the equal weight S&P. We'll see. But my guess is there's probably some running room in front of us as they launch spot Bitcoin ETFs in the US. There's a 5% weight in our macro portfolio. We have a 5% weight in Ether as well. So the market broke out across the downtrend at the beginning of 2023. Very shortly later, we pulled back and tested that downtrend line on March the 15th. And that's when the market started to broaden. If we look at what's happened since then, the TSX over that period is up about 7%. The equal weight S&P is up about 8.5%. The bond indices are about flat. High dividend paying stocks are up about 5%. The commodity index is up 11%. And the long-term US bond is down 11.7%. Over the same period, we're pretty happy with how the pools and funds are doing. Combination of our equity and income pool is up 11.5%. Combination of our equity, income, and balance pool up 10.5%. You can see the different sub-indices below. We're making progress, but it's the beginning, not the end. When we look at the risk metrics in the market, credit spreads continue to contract. That tells us that bond investors are not concerned about a credit crunch. Volatility, we're highlighting this every week. Volatility has moved to very low levels that are similar to what happens during a cyclical bull market. And we're very close to making a new all-time high. So we don't know whether it's going to be this month or next month, but we're very close. It's been 24 months. That's a long time for a cyclical bear market. We know what happens after cyclical bear markets. You get cyclical bull markets. And we're positioned in groups that are set up and performing well now and have been for the last 6 months. If things get more difficult, we'll get more defensive. If our breadth models start to turn down, it means the market's concerned about something. But that's not happening now. They're improving. Sentiment has just had the largest improvement in 1 month going back over the last 20 years. The last time it happened was in the spring, the month of April 2009, at the end of the financial crisis. So we know there's cash on the sidelines. We know there are people that are concerned about the economy and are sitting in T-bills and money market funds. But the conditions in the market are commensurate with a better environment and one we want to participate in. So if breadth models start to turn down, we'll get more defensive. We take this day by day and week by week. If things start to change, we'll tell you about it on this webcast. But in the meantime, got to move forward. So with that, Pamela, if there's any questions, certainly happy to answer them.
Hi, thanks so much, David. Great presentation as always. We have a question here looking for your thoughts on the recent moves in gold and Bitcoin. do you believe the rise in Bitcoin can be seen as a positive signal for a risk-on rally?
Yeah, look, we talked about a little over a month ago that the US dollar, the trajectory and the rise of the US dollar and the trajectory and the rise of yields was putting a damper on risk assets, and that they were overbought and they were likely to back off. And so certainly over the last 6 weeks now, we've seen the US dollar pull back, and we've seen yields pull back, and we've seen breadth improve, and we've seen risk assets behave better. So certainly I do think that that is healthy. The fact that we're getting close to the launch of Bitcoin ETF, spot Bitcoin ETFs in the US probably has people front running that. But also, I think that the pullback in yields takes the pressure off of gold. And gold has been setting up here for a long time. Sometimes all you need is a spark to ignite things. And I think that we're seeing that over the last month. So certainly we are into a more risk-on environment. When we see, things like gold acting a little better, we see Bitcoin acting a little better, we see some of the global markets acting a little bit better, we see some of the economically sensitive groups acting a little better, that's a risk-on environment.
Following that question, when you decide, or when Barometer decides to buy or sell a stock, what portion of the decision is the broad market technical info versus the fundamentals of the company?
Yeah, that's a great question. So our fundamental group are always building a list of farm team companies, things we'd like to own, things that meet our business tests, things that are technically sound, things that are good getting better. We'll only add those positions if the backdrop for the group that they're in is showing improvement. So it may be that we see, for instance, we look at the utilities have been weakening and weakening and weakening. And, we do have some candidates that we would like to own if the conditions were to improve, but that's just not happening at this point.
Thanks so much, David.
So those are sort of two key points.
The last question for this evening comes from a dear viewer of ours, Alejandro. He wants to know if you're familiar with the PAVE ETF. If so, do you feel that it is a good option to bet for further strength in the US industrial and manufacturing trend?
Right. So we own the PAVE ETF in our global portfolio. And that's the way that we are getting direct exposure to infrastructure built in the US. So yeah, I think it's a great holding.
Well, Dave, as always, that concludes our questions for today. You've provided a very thorough review, and I will leave you, as always, with the final word, and see you same time, same place next week.
Yeah, look, thanks everybody for tuning in. It's been a long year, and I'm sure everyone's looking for a little bit of downtime. I'm not going to be here next week. I'm going to take 1 week away before the holidays, but we'll be back after that. Look, I think all we can ever do, any of us, is continue to reevaluate the environment that we're in, look for change, be prepared to act when it happens. Stop losses are a big thing for us. They help us not to get too vested. When our sector work changes or our market work changes, the portfolios have to change. So a job for all of us is look forward, not look backwards. And as I look forward right now, the conditions look pretty conducive to making returns in the market. So we look forward to the next number of months coming forward. Thanks very much, Pamela. Thanks everybody for tuning in.